So welcome to the show, everyone. I'm here with Steve Blackwell, CEO of Invito Energy Partners. We're going to talk more about oil and gas, the tax savings opportunities, the profitability, and what that is going to look like when it hits your 1040, especially if you also have real estate investments. This is going to be a great conversation for some of you guys who are looking for tax savings and passive cash flow, but do not want to deal with tenants, or you don't have rep status, or you don't want to go into short-term rentals. So we're gonna have a great conversation on all this. If you enjoy what you hear, you want to learn more, hit subscribe, hit that like button, subscribe to the podcast and the YouTube page. And if you know anyone else who may be interested in learning about what we do with our clients or joining our team as an advisor, send them to info@markprolbergcpa.com. All right, let's get started. Steve, tell us about yourself. Give us an intro in 60 seconds or less.
Awesome. Well, appreciate the invitation, Mark. I'm excited to get a chance to chat with you and your audience. But yeah, my name is Steve Blackwell. I'm the co-founder and CEO of Invito Energy Partners. Long and short of it is, I got about a 17-year career as an executive running upstream oil and gas operating companies. A couple of years ago with a partner of mine who ran operations for me at the last two operating companies I was at. One I was the president, the other one I was the COO. We decided to open our own company, open up Invito Energy Partners, which is Invito, by the way, is Italian for invitation. And there's a little bit of a story behind that. Maybe we'll get into it. But yeah, basically we saw a need, or basically a place in the marketplace for a fund. There's a lot of direct energy investment funds that are out there for clients and for investors. But specifically, we have structured our deals where we feel like the investors have the best chance of a proper return, which really comes down to the fee structure. So in our opinion, most of the deals on the street are extremely over promoted on the fees up front. So you want to have as low fees as possible, so the majority of your capital is going into the asset. So that's us.
Wonderful, wonderful. Now let's talk about this here, because we had a great conversation some earlier in an earlier podcast, but you know there are some when you're evaluating how to invest in oil and gas, because you hear about all these wonderful things with tax savings opportunities and the profitability, but you know you'll also hear that people may not have such wonderful experiences, especially when it comes to the cash flow and the profitability in these endeavors. And you know, we talked about this, that you know you want to be careful and do your due diligence and make sure you're investing with the right people. So can you walk us through, tell us about what an investor needs to know to make sure they're making the right decisions here?
Yeah, I mean, look, at the end of the day, I think you're very familiar, and probably a lot of your clients from past conversations, that direct oil and gas investments have, you know, really unique and significant tax benefits and the ability to offset ordinary income, even though it's a passive investment, and you can structure it to offset passive income as well. So that's kind of a given, and that's a great reason to consider it and look at it from an investor standpoint. The challenge with oil and gas, it's a very, very technical business. You know, compare that to, not that there's not expertise in commercial real estate, or multifamily is a great example, but you know, most investors with some financial knowledge can look at a rent roll, right, and evaluate a rent roll in a spreadsheet and get a kind of a clear understanding of what the projections are and if those are realistic. But that's a far cry from the technical aspects of what comes into oil and gas, because at the end of the day in oil and gas, when you're drilling a hole into the ground and estimating what comes out of that, and there are so many disciplines that go into that, from the land side to the geology side to the reservoir engineering side, which is essentially the discipline within the industry of taking data, dumping it into software, and determining how much you think is going to come out of each well, which is called the EUR in our industry, which is estimated ultimate recovery, to the production engineering, to the the operational engineering. It's the drilling engineering, completion engineering. It's extremely technical business. So that makes it difficult for the average investor to really audit with any certainty the financial projections so that are given to them. So my suggestion to people always is there's, there's a, like, we'll provide people a list of questions, right? We've provided this, like, there's the questions for the sponsor. There's questions you should ask the operator about the operator. And then there's questions about the deal, which are critically important. In some deals, the sponsor and the operator are the same. So for example, like us, we're the sponsor and we all are as well the operator. We will invest in non-operated projects as well, but we operate a lot of our assets. So there are critical things to understand and learn about the industry. But I always tell people, look, who you're investing with is always very important. So, this is the sponsor and operator risk, more so to the sponsor. What is their background? Not only what's the background of the owners? Have they been in the oil and gas industry their whole career? Have they worked for other companies? Have they worked for large public companies? Have they worked for mid-sized public companies? Have they always just been out on their own? Did they used to be in a different industry recently? Who's their team? Do they have technical expertise on their team? And then when you're looking at that team, what's their background? Once again, have they been in the oil and gas industry their whole life? Do they have a reservoir engineer? Do they have an engineer on their team? Do they have a geologist on their team? How do they do their evaluations? Can they even speak to how they do their evaluations? Do they have a financial model that they could share with you and say, this is how we evaluate deals. Here's the model we dump it into to show how we're projecting returns. Those are great questions to ask. And, a lot of times based upon those questions, you might get a good feel for what you're dealing with. So there's a lot of different ways to look at it, but who are you investing with? What's the sponsor? So I will tell you that one of the biggest things in this industry that you have to try to avoid is what I just call promoters. So, the common, I'm not trying to talk down anybody else, but look, the common promoter is somebody that's promoting 1 or 2 vertical wells. They're usually offering those on a turnkey contract. Their background typically has not been oil and gas. They typically don't have a technical team on staff. They're typically doing a non-operated deal. So they're just passing along to you what somebody else is telling them about their deal. And they're usually doing 1 or 2 well projects, and they're typically always vertical wells, and they're always sold on a turnkey project. And turnkey is one of the biggest red flags in this industry, which is a very common way of selling deals.
Tell me more about identifying how to identify the difference between someone like yourself and a promoter, and what is a turnkey versus what you do.
Yeah, so turnkey is very simple. Essentially, the easiest way to give the example is, let's say if you're to make the numbers easy, the cost to drill a well is $1 million, right? They're going to offer that. So that's the cost that they get from the operator that's actually drilling the well. So promoters are typically, they're never operators. They're almost always doing a non-operated deal. When they're offering in a turnkey, they basically get the cost from the operator, and then in their offering documents, they'll say it's a $1 million well, that's the cost, but when they pass it along to their clients, it's a $2 million well. So they typically, I hardly ever see a promote on a turnkey that's less than 50%, meaning a 50% markup. So that's a substantial cost built into the deal. And that's one of the ways they make their money. So they'll say they don't have any fees up front, but where their fees are is in the turnkey prospect. Now that turnkey has some risk to them, because if there's an overrun from the operator, they got to take proceeds out of that turnkey to cover that cost, because most of the time they're telling their client there's not going to be a capital call. But turnkeys are always, you can guarantee you're always paying at least 50%. It's very common to be 100% over the cost of the actual well. So that's just essentially how turnkey deals are done. So we don't do turnkey deals. We do everything at cost. The way our funds are structured, we just have a one-time fee up front from a management fee of 4%. So 96% of our investors' capital goes into the ground, into acquiring working interest in the wells. And we're by far and away, no one's even remotely close to having fees as low as ours. People will say they have low fees by saying they have turnkeys. They will say they have no fees up front. But that's a very misleading statement, because there's substantial fees in turnkey.
What do you say to a potential investor when they say, well, what's the risk that we lose money or have no oil in the area that we're drilling? How do you talk about assessing risk and probability of an unsuccessful project?
Yeah. So as a guy who's been in oil and gas for a long time, I drilled a lot of wells, and literally in my career, I've probably been a part of well over 100 wells, and have had essentially no dry holes. The only well that didn't produce anything was a mechanical failure downhole. So that said, when you're in oil and gas, I think it's absolutely critical to be honest with folks that this is oil and gas. We are drilling holes in the ground. There are ways to manage risk by having more multiple wells in a fund. But at the end of the day, there is a probability, there is a chance that you could lose your money. You're always going to have the guaranteed of the tax benefits. But when you're drilling a hole in the ground and putting pipe in the ground, and sometimes going 4, 5, 6, 7,000 feet deep, maybe a mile or two lateral, depending upon if you're drilling a horizontal well, things can happen downhole. You can have a mechanical failure, something could go wrong. That's not a high probability, but it can happen. From there, it just depends on the type of asset you're investing in. So this is, again, back to who are you investing with and what is their background? Because our job as asset managers is to determine where to put the capital, right? So we have a lot of experience underwriting deals, developing deals, bringing deals in, putting them through a model, running the geology, running the economics, running the engineering, and determining where we want to put our assets. There are different levels of risk in oil and gas. A common term in the industry is called wildcatting. And that's kind of a really a hit or miss kind of a proposition. Usually when you're in a wildcatting, it's a high degree of risk that you will get a dry hole or a non-economical well. But on the other side of that equation, the upside sometimes can be 4, 5, 6 to 1. We don't engage in any of that, especially as a fund. So we're trying to go into areas. And again, if someone can't define their investment thesis, right? So in the real estate space, that's what? Location, 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 right?
Mm-hmm.
Oil and gas isn't too much dissimilar, other than I would say it's data, data, data. So when we're looking at assets, we're looking to go into fields that have significant historical production. So that historical production gives our reservoir engineer and our geologist significant amount of data to map the play, to do the reservoir engineering. So we're looking for areas that have lots of historical production. Typically that's vertical production. We particularly mostly drill horizontal wells. That's another difference between what I wowould say promoters and more what I would call oil and gas professionals. Is the promoters don't really get into horizontal wells because they don't have that. There's a lot more capital required to do that. So we're looking for areas that have lots of historical production so that the reservoir engineer, the geologists, the engineers can do their jobs and have data to dump into their systems. And then from there, we're looking for whatever our thesis is. Let's say, for example, that I'm going to drill where we're at today. If I'm going to drill a horizontal St. Andrews well, and wherever my locations are, wherever my acreage is, I don't want to be the first mover. So if there's not another horizontal well or a vertical, whatever I'm doing and whatever zone I'm drilling into and where I want to produce from, if there's not something within 5 miles, and 5 miles of stretching it, we typically like something within 2 to 3 miles, but within 5 miles max, we're not going to participate in that type of an asset because it's, from our perspective, it's too risky. Plenty of people do that in oil and gas, and it depends on the type of capital they have. There's nothing wrong with that. But from our perspective, if we're investing private capital from investors, that's one of the ways we manage the risk. So we're looking for data points that prove our thesis within a 5-mile radius of our assets, and you should be able to demonstrate that on a map to your investors, as well as we're going into areas that have lots of historical vertical production to give us data to do our analysis. And the last thing really is what's called infrastructure. So we don't want to go into new plays again where we have to put in the roads, we have to put in the electricity. Almost all wells produce water. We have to drill a saltwater disposal well. If there's not any infrastructure in place, we will put some infrastructure in place, but we don't want to, as a fund, we don't want to be the extra added expense of having to put all the infrastructure in place as well. So that's kind of how we do our underwriting. We're looking for historical production data. We're looking for data points within 5 miles that prove our thesis, so we're not a first mover. And we're looking for some level of infrastructure already in place before we choose an asset to invest in.
Gotcha. And, so what do you, so at, at this point, because you've done a good share of this stuff, you have a decent level of confidence in the likelihood it'll generate profit. And what would you say if there's any way to measure the degree of variability that, if there's a way to say, well, we predict an ROI of, let's say 25%, what do you think the variability is based on uncontrollable circumstances? Would it be like a standard deviation of maybe 5%, or what can you kind of project as best case and worst case scenarios and an expected scenario?
Yeah, and just backing up to your last question, I think what I said was a mouthful for people who are listening, right? But what I would say to you as an investor is ask them what their underwriting and asset criteria is. If they can't give you an answer like I just gave you, that's a red flag.
Mm-hmm.
So you don't have to understand it all, right? But if you ask the question and they stutter around it, or they don't give anything that sounds very detailed, that's your first red flag that maybe you're not dealing with someone who's an oil and gas professional. The answer to your next question that's a difficult question to answer, because here's how I would answer that. If I go into a field and I drill 10 wells, and I drill 10 of the exact same wells, meaning they're all the design of the well is the same, the depth, the location, where we're producing from, the design of the completion, everything is the exact same. Out of those 10 wells, let's say that you're estimated that the EUR is 300,000 barrels. Okay. You literally could have a well that's 220,000 barrels. You could have a well that's 350,000 barrels. The average, what you're thinking is when you're done, is around 300,000 barrels. So the statistical variance, and this also varies based upon the basins you are in, but the statistical variance can vary significantly from well to well. So how do you manage that risk if you're an asset manager investing private capital? Well, the best way to do that is to have diversification of the number of wells in a fund. So again, a lot of the deals I see on the street are 1-2 well programs or 1 well programs. You're going to drill this 1 well. You're going to drill these 2 wells. There's not to say that that's in and of itself is not a reason to do it, but if you drill 1 well and something goes wrong on that 1 well, you have no other well or multiple well to offset the fund. So as we grow and as we get bigger, one of the advantages we'll have is to be able to diversify the fund with multiple wells. We can do that through operated projects, but also by participating in non-operated deals. And so there's a decent statistical difference between wells from well to well. Oil and gas there is absolutely no exact science. You can sit in a room with a bunch of reservoir engineers and you'll have 10 reservoir engineers. And as a non-technical guy, I'm a finance and accounting guy. I've been running the company, so the asset teams that report up to me. But I've sat in enough, production meetings and asset development meetings, and I could have 10 engineers in the room and I have 10 different opinions. And they'll all tell you with certainty why they're right. Right. So again, when you're running a financial model for an asset development or project, you're always building in those variances, right? So, but you always have to start somewhere. So the EURs, if the EURs are 300,000 barrels, you're going to run your model based upon that. But then you're going to run sensitivity analysis, right? So what if our EURs are 280? What if our EURs are 310? What if oil prices average this? What if oil prices average that? Another big reason you want to have a lot of data up front is a large part of the performance of your fund in a well is how much does it cost to operate that well after it's in production, right? And so if you're not an operator, you're trusting that your operator has a good sense of what those costs will be. And the best way to have a sense of what the cost will be is to look at what the costs were for other operators in the area, right? So, if you're producing a well and you think it's going to cost you $15 a barrel to produce the well, which is called lifting costs, right after you're producing it and your costs are 35, you've got a problem. Now, on the contrary, you're hoping as you develop a field, you'll reduce those costs. So I don't know if that answers your question, but there's no exact answer to that question. I wish I could tell you it's 5%. Just know that from well to well in oil and gas, that's the nature of the risk difference between commercial real estate and oil and gas. Commercial real estate, I mean, you look, you got a rent roll that's 96% occupied or 90% occupied. It's already rented. You can see the rent roll. There's a lot of, confidence in what that rent roll is going to look like. Now, obviously things can happen in the commercial side as well, but it's a lot different in oil and gas.
Would you be able to create a fund? So let's say I have $125,000, $150,000 to invest. Would I be able to invest into a fund that has equity in multiple wells, or would I just need to invest maybe $200,000, $100,000 in each well?
I think it would be pretty difficult for an individual investor to achieve diversification by trying to find individual well projects. And again, I'm going to tell you that those are the primary deals that are being done by promoters. So that's why we've set ourselves up as a fund. So if you want to go invest in a commercial real estate fund, you're looking at the team and their backgrounds because you're trusting that they're going to allocate the capital. If you're going to try and get the expertise yourself, that's really, really difficult in oil and gas. So it's critical to believe in who you're investing in and are they oil and gas professionals? That's the biggest question. Where and really, are they oil and gas professionals? Look at their resumes, look at their LinkedIn profiles. Have they worked for oil and gas companies? And who's on the technical team? And do they have any track record with themselves? If the fund is new like us, obviously we don't have a track record on our funds because we just started. But we have a significant track record, myself, my partner, our geologist. I was the president of a company called Petromax Operating. And, while I was there, we divested of, 3 operated projects for over $800 million and a couple other non-op projects for another couple $100 million. So we had a really good run while I was at Petromax, and that's where my partner and I met. And the geologist that was on our team there is with us today. So I personally think the best way to manage risk is to put your money into a fund who's going to have diversification.
Okay, great. So let's say I wanted to invest into a fund. What would be my minimum that I would need to invest into a fund with you?
Well, there's lots of funds, not a lot of funds on the street. And that the minimums vary, but for example, our unit size is 50 grand. And so our minimum investment is a half unit. So we will take half units for 25 grand. We don't get a lot of $25,000 investments, but mostly when we get a $25,000 investment, it's somebody who just wants to dip their toe in the water. But the biggest thing about oil and gas for clients to understand is it's not a liquid asset. So whatever you're putting into an oil and gas deal, you're not going to be able to call up and get. Now, some documents might try to say that there's some redemption, but I'm just telling you right now, it's not going to happen. And you're going to take a massive discount if you are trying to redeem it. Whatever you're putting into an oil and gas deal, you need to assume it's a long-term hold. And if you sell it too early, by the way, you give back all the tax benefit, the majority of the tax benefits anyways, to what's called IDC recapture. So for example, you put in $100,000 with us and we turned around and sold the asset 2 years from now, almost all of those tax benefits that you got in year 1 or year 0, basically, are going to go back through IDC recapture.
It's similar to depreciation recapture, but I imagine if you wait a little longer, where the intangible drilling costs have been lost their redemption value, then the recapture is far less, if anything.
Yes. Yeah. So that's why in our funds, we typically tell clients once we get past year 5, we will look for exit strategies. So when we've run the models, once you get past year 5, there's not gonna be a lot of IDC recapture. The way oil and gas works, it's a declining asset. So that's another unique aspect of oil and gas. You're getting the majority of your cash flow early, which is why you have higher IRRs in oil and gas versus commercial real estate. And so the majority of your cash flow has come back in those first 5 years anyways. And so once you get past year 5, it's good to look at strategic opportunities to, pull the rest of that cash flow forward and distribute it to your partners. So, and really, when I say strategic opportunities, right, it depends on what you can get for it, right? If the market's down, maybe oil's down, gas is down, or maybe your fund size isn't big enough yet to get, a good multiple. So maybe you combine it with a couple funds. Just there's multiple things that can go into that. But if you can get a good multiple, pull forward maybe 3 to 5 years of cash flow and then exit, distribute that. That's a good strategy to look at. And that's what we do.
Cool. So if you so what are typical IRRs? And to the audience, internal rate of return is when you consider the ROI, the return on investment, which is your profit each year, and then also your future capital gains. So the increasing value that'll eventually be turned into capital gains. If you add those together, that's your IRR.
Yeah, the time value of money is the biggest difference, right? IRRs, what drives the IRRs is the time value of money, how long it takes you to get your money back. So that's why oil and gas projects have higher IRR. So again, here's another difference I would say between us and what the kind of language you'll get from a lot of people that are offering oil and gas deals. Right. So, and what I'm talking now is about return profiles. So when we go underwrite assets, I can tell you the criteria we look for when we're looking at an asset. And I just gave you that: data points, historical production, data points within 5 miles to prove our thesis, invest infrastructure in place. Now, when I run it through a financial model, I'm looking for what I call price beta. So I target, me personally, we favor oil deals. So we're never really going to, we could talk about this if you want, but we're not really big. I don't think we would ever participate in 100% dry gas well, only because when I look at the United States is so flush with natural gas reserves compared to oil. And when you look at the price charts of natural gas versus WTI, you'll see much longer extended periods of depressed natural gas prices versus oil. Oil goes down, it doesn't stay there very long, maybe 3 months, 4 months, top 6, and it comes back up. As an oil and gas guy, anything above $60 is gravy for me in the oil and gas business. So if we're underwriting an asset, so with that belief, when I underwrite an asset at a $60 target, if I can deliver a high single-digit return or a low double-digit return annualized, which will equate to about in the 30% IRRs. If I can hit those targets, I will, at $60 a barrel, we will consider that asset. On the contrary, let's say that I need $75 a barrel to hit those numbers. There's where your price beta comes into play. If I need $75 oil just to get the high single digits or low double digit returns, and anybody can pull up a price chart and see historically, that's not where oil stays for any extended period of time right now. Now, I think over the next 5 to 10 years, we're in a very bullish cycle for oil, but still, it's a commodity price is very volatile. I'm not going to bet on, if I need $75 oil for that to work at those levels, I'm not going to invest in that asset. So if you look at our financial projections, when you get to the $80, $90 oils, I mean, your IRRs are, through the roof, 60, 70%. But we're targeting, again, this is how do I manage risk and how do I manage returns for profiles? And again, what this is not doing is staying away from what I believe is another challenge for our industry is promising. Look, I sat through a presentation. I sat through an oil and gas presentation about a month ago for another company. I of course won't say the name, but when they got to the projections of financial projections in a 12-month time frame, in 1 year, what they said to the clients is you could make 250% on your money.
That's
Okay, I'm just here to tell you that's never going to happen. That doesn't happen.
Mhm.
So again, you can make promises like that because you can go stick any EUR you want and put any pie in the sky projection for oil prices or natural gas prices, and get crazy returns. I mean, if you could go invest in that area and get 250% returns, everybody and their brother would be investing in that area. So again, if I'm looking, this is an alternative asset, right? This is an out of the market asset. So if I'm looking in my personal portfolio, right, to diversify and create some hedging in my personal portfolio, to have some out of the market assets, rotate some of my stuff out of the market, have some tax benefits, have some stuff that creates passive income, which I know a lot of your clients do, and be out of the market. This is oil and gas is a great alternative for that, but it's a great alternative in the sense that it's not liquid. So you have to consider that. And it should have its proper allocation within your alts, within your personal portfolio. What do I mean by that? If your allocation is 40% to alts, would I tell you to put 40% in oil and gas? No, I wouldn't tell you to put 40% in oil and gas. I would tell you to mix that between, I mean, alts is a huge umbrella, right? There's private credit, there's all types of commercial real estate. Oil and gas is a great consideration. And of course, oil and gas has tremendous tax benefits. And sometimes you can use oil and gas very strategically. We've been working with a lot of clients who have been, we do a lot of work with financial advisors. So one of the things I've learned myself is this Roth conversion. A lot of people they're taking a lot of clients and converting their IRAs, their traditional IRAs, to a Roth IRA. The biggest downside to that is you have to pay the taxes right then when you make that conversion. So they've been combining it with an investment. If the client has the liquidity, they've been making an investment into our fund, which wipes out that tax bill. So it's a home run if it works for the client. So sometimes you can take a bigger piece of allocation because you're accomplishing a strategic objective. But if you're allocating 10 to 20% of your alternative portfolio to energy, I would say that's a proper allocation to a balanced portfolio. I don't know what's your kind of thesis on that?
As far as how much to allocate to the energy, I mean, that's,
Well, I mean, alternatives in general. I'm curious what what do you see? Where do you kind of balance your own personal portfolio in terms of in the market, out of the market? I have some clients that are 100%. They don't want to go anywhere near the market.
yeah. Well, I mean, me personally, what I'm doing with my cash and my long-term planning is, as far as retirement and my nest egg is, I'm going to eventually phase myself out of my business, and the equity and the valuation of the business will be significant. And also I want to invest in short-term rentals because the tax savings is really good for short-term rentals right now. Now, as bonus depreciation phases down, it's not that exciting if we get to $0 bonus depreciation unless you have cash to buy multi-million-dollar properties with STR. So, I likely will consider things like oil and gas, and also I'll be looking into charitable structures to further reduce my taxes and invest into things like oil and gas and other opportunities like maybe index funds and maybe even real estate syndications. Or it would be wonderful to have passive income through ownership interest in other businesses, which would be working interest in oil and gas, because that would be legitimately passive income that I could offset with passive real estate losses.
Yeah, I think a great way to look at oil and gas is a long-term strategy in this. And what I mean by that is you don't look at it just as year one, right? If you're over a 5-year period, you're making a certain level of investment into oil and gas. At a certain point, as that time rolls on, man, and your investment after investment, you're obviously always going to get that initial tax break. And then of course, the depletion allowance that comes with, which is another tax break, where you don't pay pay tax on the first 15%, but now you're going to start to build up a nice cash flow stream, right? And so it's a nice way to build up passive income without a doubt. So royalties is another way to do that in oil and gas. The only difference between royalties is you don't get the upfront tax benefits. So I think it's a great tool used in the right way. I think it's just, I think it's proper I just think it's very important that people understand the risk associated with oil and gas versus a commercial real estate deal. And I think it's very imperative that my advice to anybody would be is just really, ask the hard questions. Don't get sold, man. Ask the hard questions for yourself on who it is and what their background is, and then dive into the PPM, dive into the offering documents. If it's very difficult, when you're reading their documents to understand how they're getting paid. And if they're aligned with you, I'm just going to tell you that's a red flag, because it's not hard to disclose that. A lot of the PPMs I read are you got to track it from page 40 to page 250 to understand all the fees. Our PPM, it's on one page. It's not hard. I mean, we have a 4% fee up front, and then we get 13% of the revenue off the wells, and the clients get 87. And after payout, that goes to 25, and we go to 25 and they go to 75, and that's where it stays. I mean, it takes like 4 paragraphs. I mean, it's not hard to explain that. So I think it's critical, and that creates alignment, right? So that's the other thing in oil and gas deals, which it is in every private placement deal, right? You don't want the sponsor making their money up front off of you. So if you're giving someone $100,000 and they're taking 20, 30, 40 grand and sticking it in their pocket and then taking the rest and invest in it, I would just suggest, regardless of whether it's oil and gas or any type of a deal, that's probably not an appropriate investment, because you're not aligned with the sponsor.
Yeah.
So
Well, have you seen anyone invest in your funds with retirement accounts, whether Roth or traditional IRAs, solo 401ks, self-directed 401ks?
you can, but nobody does, because you lose the tax benefits.
Right, unless it's where you have where you have the royalty, where there's the benefits aren't as.
Royalties would be a great way to do an IRA, invest through an IRA, because it's not, the whole thing on oil and gas, just so people understand, is, which you're an accountant, so I'm probably telling you what you already know, but oil and gas has the IDC deduction, and of course we can take advantage of bonus depreciation from the tax cut the Tax Cut and Jobs Act, which is starting to sunset this year. But the code of the sector is like, I think it's 469C3, which basically says, even though this is a passive investment, if you are investing in a way that doesn't limit your liability up front, that's why you get to offset ordinary income. That right there is what separates the oil and gas. That's what makes the oil and gas investment so unique.
Yeah.
So that's the critical one. And that, again, means that you should be investing as a GP up front. You start out as a GP. And again, if whoever can explain to you what that is or how that works, and or how, as an operator, you manage that risk for the client, again, I would say that's another red flag, because technically what GP means is you are at risk, right? Mm-hmm. So, but there are really easy ways to explain to an investor how an operator and how a sponsor manages those risks for the client, so that that's a very de minimis risk. And then, for example, like in our documents, once the last well is, in our partnership agreement, once the last well is put into production, the conversion automatically happens from GP to LP. So, but that's the big carrot that the Congress put into the code a long time ago to incentivize capital to flow towards oil and gas investment in the United States, which, of course, not that we want to do a history lesson, but the reason why that was all done is, if you go back to the 70s when it was put in place, right? We're producing about 3 million barrels a day and importing 17 million barrels a day from around the country, primarily the Middle East. It's a huge, security risk for the United States. And so they, as they do with the code, right? They use they use the code, our Congress does, to incentivize behavior, sometimes more for political reasons than for maybe the right reasons, but whatever. But that's why it's been in the code, and it gets bantered around every election season, but it never gets changed. And the reason they won't change it is because it would put a big crush onto the industry, and energy independence is, regardless of what anybody thinks, is a big deal for the United States. So we're the largest producer in the world now, which is crazy to think where we've come from. And that's all due to the shale revolution and horizontal drilling and the new fracking technologies that happened started about 15 years ago. It's a pretty amazing story.
Yeah, so and some other considerations from a tax perspective is some other interesting things. There's something called a C store. So if you have a store on a gas station, 100% of that qualifies for bonus depreciation. or at least now it's 80% of it will get that favorable bonus depreciation. Another tax incentive for energy development. There's also, we'll probably have another talk on solar energy tax credits. Is a wonderful opportunity for where you've exhausted all our options. Let's say a client owes like a couple $100,000 in taxes. We say instead of paying taxes, why don't we buy tax credits for solar energy at a discount and then generate cash flow from the assets we're purchasing using leverage. And then another consideration when you're investing in oil and gas, and this is why you really want to collaborate with an accountant. And I always say this time and time again, do not want to DIY your own tax plan, because you don't know what you
100%.
don't know. And there's just too much complexity. And when it comes to how much you can deduct as intangible drilling costs, approximately 80 cents per dollar, but you also have to consider alternative minimum tax, which may restrict the amount of tax deduction. So that's another consideration from a tax perspective, which is why it's so important to collaborate with your tax advisor through this process.
Yeah, I agree 100%. The AMT, in my experience, rarely comes into play. The only time I've seen it come into play is some of these Roth conversions. So when you're doing, if you're going to use the strategy of combining oil and gas investment to do a Roth conversion, you should always do your AMT calculations anyways. And you're 100% right. You should always just have an accountant anyways doing this, a CPA. And I always tell people, look, the IDC deduction is just basically partnership accounting. So I guess you could figure that out yourself, but you're not going to figure out depletion allowance on your own. You're going to, so if you want to take advantage of that depletion allowance, you are going to need a CPA, and you're going to need a CPA that is willing to do the work. Not that it's hard, but they're going to have to do the work to understand how to calculate depletion allowance to, take advantage, which is a big advantage, to not pay taxes on the first 15% of the income you receive. So I will, reinforce your statement, Mark, that a CPA and a good CPA is a critical piece to anybody's financial health, and a CPA who's willing to not just do returns, right? To think through things and come up with other ideas, which those are hard to find, by the way.
Most CPAs are what I call 1040 factories.
Yes.
Really just focus on reporting what happened, and they don't really advise you to be proactive through the year. And when you're at a certain income level and paying over $100,000 in taxes, you need a little more than that to have a game plan.
Yeah, it's finding a good accountant is good. A CPA partner is not only from your business standpoint, from the personal standpoint, is massively beneficial. So call Mark.
That's right. You heard it here. Awesome. Now, Steve, can you, before we go, I want to give you the opportunity. If you have any call to action for the audience, here's your chance. And also, how can they learn more about you and connect with you and maybe consider some of your investments?
Yeah, so we currently have a fund open. So our website, I mean, you can see it right there, is invitoep.com. You can go on there and click on current opportunities. Again, that'll take you to we house all of our fund on. Another thing that kind of differentiates us, we want to be as institutional looking as possible. So our fund is housed on a fintech platform where everything's digital, all the compliance stuff, all the compliance due diligence documents are in there. I have background checks. That's another thing, by the way. I would ask for background checks on your sponsor and ask them if they'll provide it. So we've paid, those were $1,500 a pop for pretty extensive background checks on myself and my partner. You want to know, look, you want to know certainly you want to know we're not criminals, but more importantly, you want to know we don't have tax liens, bankruptcies if we're managing your money. Not to say that some of those, if someone had that, it would kill a deal, but you'd want it explained, right? And then all your investments online, you can track your investment online. So it's easy to invest and it's easy to track it afterwards. Other than that, I would say, if you want to follow me on LinkedIn, I try to put out a lot of publishing. I just wrote an ebook on wealth and taxes. I try to add value other ways. If you have a deal, I make this offer every time to any one of your clients, Mark, if you want me to. If they're looking at an oil and gas deal, I'll look at it for free. I'm not going to do a deep technical analysis of the asset. I will give a cursory review of that. And since we've been around a long time, we pretty much know most things. But the biggest thing I will do for you is I have read, dozens and dozens of PPMs, so I'm pretty skilled at reading PPMs in oil and gas offerings right now. So the biggest thing I can do for people is I'll read the PPM and make sure you understand the fee structure and maybe things to look for. So no problem doing that for free for anybody. But would love for have anybody to be partners with us. This year's fund is going well. We're open. We have subscriptions available today. It'll be a mixture of operated and non-operated assets. Because of our, long backgrounds in the industry, we have a lot of relationships. So our non-operated projects are always under some of the major operators. So we're able to get small participations in some of the bigger publicly traded operators. So we blend that into our fund to create diversification. So other than that, more than happy to talk to anybody more about oil and gas if they want it. I just did a webinar recently, the thing called the Money Show, which was 30 minutes on just purely navigating oil and gas investments. Didn't talk about our fund at all, other than to say we had one at the end. More than happy to forward that recording to anybody that's interested in listening to it. So education, I'm a big believer in educating people in our industry and the advantages, but I also think it's proper for people to understand in any investment, the risks that are associated with it so they can go into it eyes wide open.
Awesome. Well, hey, Steve, one more thing. What do you do outside of work and what do you do for fun?
Well, I used to do things outside of work until I started my own business. Now all I do, so now all I do is work. I'm hoping that change. I'm 54, man. So working out is critical to stay healthy mentally and physically. So I try to get into the gym on a regular basis. I used to play golf. I still would like to play golf. That has fallen off. I know that I have kids, so I've got, I've actually got a 30-year-old and I have a granddaughter. And then my daughter just graduated high school, is heading off to college next month in Florida. And then my son will be a senior in high school. So when I'm not working, man, I'm usually at home with the family. I'm blessed to have kids that actually like to hang around the house and do stuff with parents. And other than that, taking trips. And then football season is one of my passions. So I already got a multiple football trips planned. I went to Central Michigan and we play Notre Dame this year. So I think I'm headed up to the Notre Dame game for sure. And my wife went to OU, so we usually go to a couple of OU games. I love college football, so that's always on the agendas and Saturdays. If I'm not at a game on Saturday, I'm usually in front of the TV on a Saturday, which my wife may not exactly like, but that's usually what I like to do. So
awesome. Yeah. I don't watch as much as I used to because I'm a business owner, but I'm an Ohio State Buckeye, so those are a lot of fun games to watch.
Yeah, college football is I love the NFL too, but I love the atmosphere of college football is just different. So I really enjoy it.
Oh yeah, it's a good time.
The college football is awesome. So yeah, man, and maybe I'll make it out to Atlanta one of these days and we'll get to go out to dinner as we talked about before.
Absolutely. We'll have a tax deductible meal together.
And there's limits on that, right?
50%.
There you go. That's why you need a good accountant, right? To remind you of your limits. So yeah, man. And again, my offer is there totally, man. If you have clients that are interested in learning more than happy to do whatever it takes to help them, whether it's one-on-one or one-on-one with someone or put on another webinar. I'm happy to do that.
Awesome. Steve, thank you so much for your time. You guys found this valuable. You got Steve's information in the show notes. Subscribe if you want to continue listening. And again, if you know anyone who could use our services or you're interested, email info@markperlbergcpa.com. Thank you very much.
Thank you, Mark. Appreciate it.